Yeah, ready to start? All right, great. Well, I know we're running a little bit late. I think it's kind of our job today to catch us up a little bit. I appreciate everybody taking the time out and attending our session. Make sure everybody's in the right place. This is Gaining Complete Confidence Through Numbers, Reinventing Record to Report process. My name's Ken Fritz. I'm an Executive Vice President with Trintech. Presenting with me today is Mike Duderich. He's the Finance Director of America's R2R Operations for Unilever. I need this. So just quickly, a little bit of ground rules. Our objective today is to actually transfer to you guys some useful knowledge, and we have 15 minutes in which to do that. So we're going to hopefully be able to accomplish that goal in this area of actually the area of record to report processing. What I'm going to cover in my area is what is record to report or why record to report. Talk a little bit about some benchmarking statistics and peer group versus top performers, and why would an organization or operating company consider record to report. What are some of the challenges that we've seen in the marketplace around record to report and by operating companies? What a reinvention approach looks like, what it would be. Then I'm going to turn the presentation over to Mike, and Mike's going to take you through the journey that Unilever's been on and give you some real practical insight into when they started, what they've been doing, what they hope to accomplish, what they have accomplished, and what the future looks like for them going forward. Then we're going to summarize briefly and then open it up for Q&A. Again, from a nice sized group, if you guys have questions along the way, please stop either Mike or myself. We'll answer that question. If it seems like it's going to get really involved, we'll defer it. If it seems like we can answer it right then, we will. Or we'll pick it back up again at the end of the session when we have more open Q&A. Mike and I will also be around after the session, and we will be heading to the Trintech booth, which is in the vendor display area. So we'll be happy to continue any conversations or answer any other questions that you might have at any of the breaks today. So with that said, let's go ahead and get started. I'd love to start my presentations basically with a quote. You'll find, particularly there's some of my partners in the room already, you'll find that most of my presentation is stolen from other people's presentations, and including obviously my quotes. But I thought this was most appropriate because out of intense complexities, according to Sir Winston, intense simplicities emerge. Particularly when you see Mike's presentation, you'll see that this whole area of record to report process has some very intense complexities in it. But if you start thinking about solving for those complexities in a more simplified way, you'll achieve great things. That's a promise. Okay, myths. Do a little bit of myth busting right now, or mythbusters. Myth is highly educated finance personnel are working on value-added activities. Now, in many organizations, that might actually be true. I haven't run into too many of them. Maybe, I don't mean to insult your organization, but maybe that's true. Here's more of the reality. The reality is we have a lot of expensive controllers and FP&A people that are spending 2/3 of their time on more mundane tasks. True? Myth? Yeah, pretty much. So if we're looking at improving the record to report process, thinking about record to report, it's a lot like thinking about any other processes that you guys have in your organizations. I mean, you'll call them different things. People will talk about procure to pay as a process. They'll talk about order to cash as a process. Obviously, you have other systems in there. You'll talk about your ERP systems that are impacting that, and you'll talk about other systems, but you'll look at this as a process. You know, from the record to report perspective, one of the things that one of our partners, the Hackett Group, if any of you guys have used them, you'll find out. But this is from a presentation, or basically the summary of a presentation that we did with our partner, the Hackett Group, that does a lot of benchmarking studies. And you'll see a few more statistics from the Hackett Group here around the record to report process in an organization. And here was basically the walkaway conclusions of a white paper we put together with them, as well as some presentations that we put together, or presentations that we did jointly. Some of the 5 key points here is process simplification and standardization. This might actually apply more than to record to report, but it definitely applies to record to report. Investing in integrated close. So let's look at this from a process simplification and standardization. Again, from intense complexities come intense simplification. The integrated close process, making sure things are integrated. The third one, which I'm going to focus on a little bit more in later in my presentation, which is basically the efficient and effective consolidation and close process, making that process more not just efficient but effective. We'll talk a little bit about that. Integrated systems and single version of this truth that also includes standards and the associated governance around those standards as you start with your change process. And then leverage technologies extensively and intensively and continually. So we'll talk a little bit about that as well. But again, we get back to, okay, record a report. Why would I even consider doing this? And this, again, is from the Hackett Group as far as some of their benchmarking studies. If we look at and we compare peer group to top performers in the area of record to report, the peer group itself, the top performers over the peer group has been able to reduce process costs as a percentage of revenue by 51% over the peer group. Significant. If for nothing else, if you don't, you're not trying to manage risk better, if you're not trying to just shift that Mythbusters from having high-paid finance people work on more value-added activities, if for nothing else, there's a significant area of cost savings, primarily because in many organizations it still remains as low-hanging fruit. The record to report process still is low-hanging because there hasn't been a lot of technology innovation applied to this area, as there has been, let's say, in order to cash or procure to pay, or in the whole ERP area, or in other areas of the organization. There's still a lot of low-hanging fruit to pick up here in record to report, as we'll see. Also, we call it at Trintech controlled agility, which is almost an oxymoron, but where you can be very, very flexible in adapting to change if you have a very agile record to report process, but it's really a controlled agility. So you're exercising that control, that governance, and those standards, but you're able to adapt to change very quickly. If we look at peer group against the top performers, for those that are in the top performer category in record to report, and how they compare in those times in response to, let's say, for example, in the early part of this millennium, when they had to absorb the impact of Sarbanes-Oxley, very, very little impact. The difference was 45% reduction in cost over the peer group. Same type of thing when we're looking at the recent financial crisis of how much costs had changed versus those people that have been classified as top performers in record to report. Again, more reasons why this may be an area in your organization that you might want to consider. Well, cost reduction is still a key driver in record to report. And it's still one of the few areas where you can achieve two things simultaneously, where you can actually achieve a reduction in risk and a reduction in cost at the same time. Most often, in order to reduce the risks inherent in a process, you have to spend more money on the process. It's not necessarily the case in R2R investment. In fact, Mike will even talk a little bit more about Unilever's experience in that area. But if we look at, again, some of the statistics, top performers versus peer groups, and the process costs, 51%. We look at the number of just FTEs in the overall process, significant reduction for a top performer when you compare them to the peer group. And the percent of companies that close and consolidate in under 4 days. Significant difference in top performers versus peer groups. So, We look at industry analysts and okay, well, who should I look to from a technology assistance, or how should I be evaluating this area? There's really the emergence of financial governance suites that is really there, that is really coming into play now. We talk about integration at the system level. When I have a complete solution that goes end to end, they're saying these are emerging, start to look at those. But the two major areas is close and reconciliation management and disclosure management that are included as sub-processes of the overall report process, but to give some significant due to those organizations that offer an integrated solution set that can take an organization or be with an organization on that journey, and it is a journey, to reinvent the overall record-to-report process. I know I'm moving quickly. We okay? Are you hanging with me? This is okay. Good. Want to make sure. If it's not, raise your hand. Say, move on. Heard all this before. Current challenges. Again, when we poll and we look at the marketplace, we look at what peer companies are doing, what various operating companies. We're seeing a changing role in the office of the CFO in the finance area. And it really, we put it into four categorical areas, which is there is this need for making sure there's some single truth that exists out there where I don't have, and this has been a long time goal of a lot of organizations where, you know, we spend half the meeting, the first 30 minutes of an hour meeting, trying to figure out whether it's Ken or Mike that has the right sales number, because they're not the same. How can we ensure that those numbers flow through the overall process, particularly when we start from record all the way to report, which is I've got my books closed, I have face financials ready to go, but now I have to get ready to release those to the street. I've got to push the big red button. I've got to get this out to stakeholders and shareholders alike. You know, how do I ensure I've got one version of the truth? How can I make sure that I'm agile enough with the right control to meet certain regulatory requirements that keep shifting, you know, new disclosures that I have to if I'm a publicly traded company that the SEC is laying down on me. What about other things that are coming along the lines of reporting under both the U.S. GAAP and IFRS if I fall under that? What about new formats to which interactive data formats that I have to now supply to the SEC as well as other regulators around things like XBRL? How can I continue to be agile enough that I don't have to incur additional costs and my systems and my processes can adapt to those changing environments? How can I stop working my people to death, and do I have the right governance over those people? When I exercise that control, if that control is repeated, how can I make sure I can use that control in other different control initiatives? How do I get a handle on all my controls, not just my SOX controls, but other types of controls that I need to apply in my organization? And then again, are we asking the right questions around not only the efficiencies, but the effectiveness of my overall recorded report process? And this is happening with a lot of pressure on the organization. So these are actual quotes that we had that we collected at Trintech. We were actually in this building last year at the another conference. But it's just kind of a snippet of what the question is: what keeps you guys up at night? And this was a number of chief accounting officers, controllers, and/or CFOs, and we just captured a few of them. Some of these might sound familiar to some of you folks, but these are areas of that. Dealing with risk, changing regulatory environment, basically reinforcing those items that I had on the previous slide. So, from a CFO or Chief Accounting Officer's perspective, if we're looking at evaluating a recorded report cycle, what am I really trying to accomplish? What am I trying to do? I am trying to manage risk, but the question is, do I even know what risk let's just say I'm not going to change anything. Do I know what my risk is in that process today? What is my risk? Am I measuring risk in this process? What is the risk inherent in my R2R process? What's the risk that I'm going to miss a disclosure? What's the risk that I'm assuming if we can't exercise all the controls we've laid out. I'm working with a large technology company where part of their key controls is certifying their balance sheet numbers, and they reconcile over 1 million accounts a month. Do you really need to reconcile 1 million? And by doing that costs them a lot of money. Is there another efficient way? If I look at all the accounts that I'm reconciling, can I stack rank them and continually stack rank them to determine which are my high-risk accounts and which are my less risky accounts? Can I put these on more of a schedule? Can I say, I'm going to do these once a quarter, and I'm going to roll with those because they're low risk. These I'm going to do once a month. These I'm going to do continually on an operational basis on a daily basis. So can I manage my risk? And that's just one control. How can I manage the risk and all the other controls that are within the process? How can I increase my effectiveness and my efficiency? I'm a simple guy, small brain. I always get things confused with someone talks about effectiveness, efficiency. Most people do this. They focus on efficiency because efficiency is, am I doing things right? Am I doing this correctly? Effectiveness is, am I doing the right things? Rarely, if often, are people questioning, they want to do that thing better. They want to do that thing faster. They want to do that thing more efficiently. Who's questioning, should we even be doing that thing? That's effectiveness. A lot of companies get really, really good at doing all the wrong things because they don't ask this question. So we'll talk a little bit about that as well. Again, so simple mind, simple brain. I try to keep things very, very simple. If we look at this just from a three-dimensional view, I've got risk that I'm trying to manage, and I have some levels of effectiveness and efficiency, and I've got a limited amount of time. One of the things about the recorded report process, it is heavily gated by time. I can only start the process when I got my when the accounting calendar says I can close my books, and I have to end it when the regulator says I've got to release to the street. So I've only got so much time, and I have a lot of risk in these processes. So if I were actually to say, okay, I'm going to take as much time as I need so I can shrink my risk, well, that's silly. I'm going to be past my regulatory deadline. If I say, you know what, I'm just going to move that up. It's better for me. I can reduce my risk because I'm now coincident in my earnings release and my filing to the SEC. I've reduced that risk of exposure between my earnings release date and my filing date to 0, so I've reduced that risk. I've moved it all up, but I've really increased other risks. Risk of filing wrong, the risk of getting the numbers incorrect, the risk of not meeting my control requirements. So obviously what we're trying to do is reduce that risk. The only way to obviously do that is effectively is to not only increase your efficiency, but also increase your effectiveness. If we switch this, I'm not going to let the whole slide build because I want to pick up some time. If we actually switch this and actually say, let's look at this more two-dimensionally, really what we're talking about when we're talking about effectiveness and efficiency is a transformation process. We heard that in the keynote. For those of you guys that attended the keynote this morning, you'll hear that a lot in, I think, any of the sessions today. But the transformation process improvement with the effect of reducing time, which has the same, reducing time is the same thing as reducing costs, and with the effect of mitigating risk. How can I reduce cost and risk at the same time through transformation and process improvement? Here's the advertising perspective. Trintech, we offer a product that it goes end to end, but more important, I wanted to talk about the elements of what we offer in our K&C solution that really takes the record to report process and finally gives first and foremost whatever solution you guys might consider if your operating company is up to tackling record to report, is the ability to go back to the old adage, that which gets measured gets managed. So just like the risk, if you're not measuring it, you really can't manage the risk. Just like anything in any of these processes, if you're if you're measuring the process, you can begin to manage it. So can you get some visibility to measure, monitor, and therefore manage these processes? In the whole overall close, do you have a way to use technology to exploit every step in that process, look at those processes, manage them, and monitor them against themselves? In all the sub-processes, we call them 3 different major sub-processes here. The certification process, which is your key control, which is a lot of your reconciliation processes. Your compliance processes, so how am I documenting my controls, how am I testing my controls, how am I remediating my controls across my entire control and governance environment. And finally, my disclosure management, how then do I manage the single version of the truth and see a flow of information all the way from my transaction system where a number changes there, it actually changes in my disclosure that's actually going to be released to the SEC. How do I incorporate that? How are my processes there? And then at a high level, how can I impact changes for adjusting journals or other impact changes of corrections that need to be made or other allocations that need to be made during that close process or during that recorded report process with a standard journal entry module with the right controls, approvals, and processing to shorten my cycle times, to reduce my time, and mitigate my risk. What am I going to do? How am I going to do that? Mike's going to talk to what the approach was that Unilever took in this whole area. So if someone were to ask me, so Ken, just lay out all these processes you're talking about, this recorded report stuff. This is just mind-numbing. You're doing it in, 30 seconds here. Well, what is it? So I would lay out. This is how I would put together my little graphic, right? Here's the recorded report process. We've got to close our general ledger. We've got to perform these reconciliations. We've got to do certain consolidations. We do a financial statement analysis. We have controller reviews, CFO reviews, all the way down to, we've got to tag this stuff and get it ready for XBRL filing. We've got to have some reviews done by our audit committee. And CEO has got a certified thing, and we actually get the thing filed. And this would become discussion, academic, talk to a class of MBA students about this. But here's how it often works or really works. Actually, the CFO and the executive management team are anxious to actually release, sometimes not that anxious, but they need to release their filing to the street. It's the report card of how well that executive team, that management team has done, how well the organization has done. It is the report card. It's going to hit a lot of impact for that company. But really what's happening is we know there's all these other steps that are happening behind the scenes. We know that a lot of other people are involved. And we know that necessarily that this is a very collaborative process. It's actually a reverse of everything we've been doing as a company where we're trying to get all the right reports to the right people at the right time to make fact-based decisions. Now we're reversing that trend, and now I'm trying to get everybody focused on one set of financials that's representative of the entire organization and get that out for release to regulators as well as other stakeholders and the street. Most companies that we survey and record report process are using personal productivity tools to try and impact or affect this change. They're using Microsoft Office. Outlook is their workflow, Excel's their database, and Word's their report writer. That's what most companies are using. And that's why there's a lot of control problems, there's a lot of inefficiency, and there's a lot of opportunity for change. So again, this is what we're offering in this space. And if we really look at this, we're giving that visibility and that dashboard to give that controlled agility with a Cadency product in these different areas. I wanted to set that up, and I'll come back. But really what I wanted to do at this juncture is have Mike come up and talk to you about exactly Unilever's journey, what they were doing in this area, how they analyzed it from a more pragmatic and practical approach. So I'm going to turn the presentation over to Mike.
Thanks a lot, Ken. Good morning, everyone. I'm Mike Duderich. I'm currently the finance director of Unilever's R2R operations team for the Americas, which is North America and Latin America. But truth be told, I also have a second role. I've been leading a big chunk of the project that I'm going to describe around creating one process, one capability around systems. So I've had those two hats the last 2 years. So I'm not a sales guy up here telling you about it. I'm an operational guy and also a guy who's led not the whole project, but certainly one of the members of one of the leaders of a key part of the project. So I'm here to tell you about our experience, our story, in obviously the limited amount of time we have. But before we do that, I know Unilever is not always a household name. So I just wanted to tell you just briefly about who we are, just to give you some context for the broader story. So we are a large, very large, probably one of the largest multinational fast-moving consumer goods companies in the globe. We have about 173,000 employees across 190 countries. Our reported turnover, which for those who are in the U.S., net sales revenue, it was 53 billion euros in 2012. So we are an extremely large company, and I think the key number to remember there as we go further into the discussion is we do operate in 190 countries, which means we close the books in 190, generally, plus or minus 190 different countries. Most people know Unilever, but more people know Unilever by our brands. So I just wanted to share with you our billion euro brands, and that's revenue when I talk about billion euros. So we do, just before we talk about the brands, we do operate in 4 product categories: personal care, foods, refreshment, and home care. Our biggest brands, you can see we have 14 brands that generate over €1 billion of turnover, which is excellent. The brands that are most well known here in the U.S., because I know I'm talking to a U.S. crowd: Hellmann's, Knorr. This brand is Good Humor in the United States. Lipton, Dove, Sunsilk, and Axe are the biggest brands that we have here in the United States. Somebody's probably going to ask me, well, where's Ben & Jerry's? Ben & Jerry's is one of our brands. Well, despite all the publicity it gets, it's not a €1 billion brand. So it's, but obviously many folks know us by Ben & Jerry's. So first I wanted to share, there were really 2 what I'll call game-changing steps in how we got to our transformation and how we got off and running. The first is around about 3 years ago, we determined within Unilever, totally unrelated to record to report or finance, that we had a real opportunity to leverage Unilever scale. We are a global company with 190 countries, but quite frankly, our legacy is operating in a very decentralized manner. So we really, while we had taken some steps to drive scale in buying and some of those areas, we really hadn't fully tapped out the potential there. So a decision was taken, a strategic decision is that we were going to identify a number of different service delivery lines, call it speak back office type areas, not just in finance, but in other areas of our business, and really ring fence that, bring that together and really drive scale. So we created an organization within our Unilever global organization called Enterprise Support. The main objective was really to drive better support and service to our customers and consumers, mainly our internal customers, right? Because we had a very fragmented approach in a lot of the service delivery areas. But the biggest benefit, as I mentioned, was really translating our global scale into local cost competitiveness. And really that was the main business case driver for creating up an enterprise support organization. Do things one way, provide excellent service internally, and drive scale in all service delivery lines, including finance and R2R. That also, as Ken mentioned earlier, that does create maximum agility, right? So if you're centralized and leveraging scale, it's easier to deploy change, right? So when you talk about agility, that's what it means in our organization, right? And it's really clearly benefit to being able to be fast and agile, particularly in the fast-moving consumer goods industry. That then led to the formation and the vision around creating an enterprise support finance services organization. So there's a lot on this chart, but I think I'd like to draw your attention to the middle box. Once again, building on the overall enterprise support strategy, the main reason for being and vision for this organization of finance enterprise support was really to drive excellent services within the organization at externally benchmarked costs. So the mindset that we started adopting in all these areas of enterprise support, including finance, is not only just ring fencing an organization and driving service and lower costs, but making sure we measure ourselves externally, and not just. So in theory, you could always outsource. Not that we were pushing to do that. In some cases, we are, but you always felt like we were providing the best service at, like I say, the best external cost and not justifying our existence internally from a cost perspective. In addition to that, and this then sets the stage for my next few charts, the levers to get us there, because this is once again a vision and where we want it to be, how do we get there? We launched really 3 major initiatives. One I'll call transformation programs, and I'll talk about what that means for Record to Report. We also had a retendering project with our third-party service providers for R2R. And also we created this concept, which I'll talk about in a minute, around operating center, centralizing expertise and subject matter expertise. The other big breakthrough for us as an organization is we began looking at our Record to Report process as one end-to-end process. I mean, we typically would close the books in the countries, throw it over the wall to the consolidations team in London. They would bring it together, then we'd throw it over to investor relations to communicate it and build a story. Well, we started to look at that end-to-end process and said, are we really optimizing it? And that really, separate from obviously this whole service delivery, low cost, we started looking at it in a very different way. So the next big event, I said there were 2 big game-changing events. The second big event, and I talked about the transformation programs on the lower right-hand previous chart, we kicked off what I'll call a major game-changing project for us as a global organization. So I happen to work out of the US, out of North America, but we felt in order to gain the scale and the benefit we were really looking for, we really needed to drive this at a global level, okay? So in 2011, just to categorize the type of business we were in terms of Record to Report, we were reporting end-to-end in 5 weeks. And when I say end-to-end, from the day we closed the ledger to the day we reported to the financial markets. We had very inconsistent and complex processes. Remember the 190 countries? We were closing the books generally the same way, following standard chart of accounts. But in the end, we were, there was enough deviation where we weren't maximizing the value there. Our goal in 2014, which is next year, is to get to 2-week reporting. And we know 2-week reporting is best in class, unless it's moved in the last year. Because when we started this journey, we actually worked, and I met Jim earlier from Hackett, we actually understood who were the fastest reporting companies in the world. And we determined that was Cisco and Alcoa. So from the day they closed the ledger to the day they go to the financial markets, I can't remember which was which. One was, I think Alcoa was five working days, 1 week, and Cisco is 2 weeks. So we knew that that was the best global in class, and that was our goal, okay? There were many steps along the way and different things that we needed to do. So clearly, I mentioned earlier our ES finance organization. We needed to embrace this one single finance services organization mentality. We were looking to build an agile and scalable organization. We talked about, because in the end, we're really looking to drive, while we were looking to reduce cycle time, at the same time, we were looking to put a sustainable model, low-cost model from an R2R perspective at the same time. And then back to some points that Ken was making earlier, risk reduction, so we looked at the cost of risk, we looked at our controls, and clearly the fact that we had this very fragmented, decentralized organization, it really made it that much more costly and difficult because everybody was doing it slightly differently to really gain the scale and to reduce the cost of risk and also to ensure that we had greater compliance, right? When you have fewer touch points, which was our vision, you obviously put yourself in a better position to drive greater compliance, okay? Now, I didn't actually make a mistake here. The question is how did we go from that vision and those programs to where we are today and how we move forward? So rarely, I think everybody in this room would say, rarely in our finance careers, if ever, do you get an opportunity to start with a clean sheet of paper. So we literally started with a clean sheet of paper and said, if we were creating Unilever today, 190 countries, and obviously the vision that we had set out for ourselves in the new world, how do you get there? A massive company. I mean, we had 190 countries who were not only doing it their own way, but of course very passionate, right, about their way of doing things. So we started with a clean sheet of paper. And then what did we change? So we started and we said, okay, really in the end, in order to enable where we want to go, to deliver this type of vision, we need one global process blueprint, on how we're going to drive our R2R process one way in 190 different countries. We need one set of tools to enable those processes. Okay, so you always start with process and then you come with tools. You don't pick tools and then say, how do I make them fit and how do I get people to embrace them? And then we had an organizational piece where we said, we don't want 190 different countries doing things differently and having to chase them to follow the global process. We want to centralize and create centers of excellence and what we call operating centers to centralize expertise and to centralize owning that end-to-end process. And of course, underpinning all of this is we packaged this, the new way of working and how we wanted to do things. And we went to, and it just so happened we were due to retender our third-party contracts and said, this is the way we're going to operate in the future. You know, please tell us what it's going to cost. And we actually had an open retender for our third-party providers and very aggressively said, this is the way we're going to operate. Do you want to be there and tell us what it's going to cost us? And we use that as obviously a big leverage going forward. Now, just coming back to process, what we did was we looked external. So once again, we start with a clean sheet of paper. It could be anything. We've used Ernst & Young, we've used Capgemini, we've used Hackett. So we got a lot of input and then figured out what the best practices were and what we wanted to do. On tools, and we'll look at that in a second, we basically said, okay, here we've developed the processes, here's where we need to enable. So now who are the vendors out there who deliver the best services and tools in these areas? And likewise, what we did is we had a huge shift, which I'll show you in a second, of moving most of the people out of the country into these operating centers, the Unilever people, and pushing out in a consistent, harmonized way, consistent outsourcing by process. So we said if, fixed assets, it'll always be with a third party, obviously overseen by the operating center, but no decision country by country. I like to outsource fixed assets, I don't. It was a harmonized one way of doing things. So just to go piece by piece, as I said, we developed one global process based on external best practice. We actually broke down first we had to define the scope. What is R2R? Where does it stop? Where does it stop? Because of course you have supply chain and you have a lot of other different processes that come in. We defined that, and then first step was developing process maps that identified key control points, where we wanted automation, where we didn't. That then led to narratives to describe the process, right? So just to get people to embrace it, because in some cases it was very different from what we were doing today. In some cases it was similar. And then none of this really matters if you can't operationalize it in a desktop procedure. So then we took the final step and said, okay, let's develop desktop procedures so that the rubber hits the road, okay? So this was capability building that we did in year one. So I showed you 2011. In 2012, it was really all around building capability in this space. We talked about tools. We looked at 3 areas where we identified automation opportunities, streamlining. One was in journal entry and workflow, account reconciliation and workflow. Then we had a standard workflow that we've identified, a closed monitoring tool, intercompany tools, and also GL to reporting system interface. So of those 4 tools, of those 6 tools, 4 we've implemented today as we've started our deployment journey. There's 2 more that are coming in 2014. So once again, it is a journey, as Ken said earlier. You don't just flick a switch and you flip to the new process and new tools. As I'm sure all of you guys know, it's very painful to implement new tools and changing mindset and all the details. So but we're well away on that journey. I'll just get a Trintech plug in here. So of the 6 tools, we really, for journal entry and account rec, felt that Trintech was the best option for us. We have selected other vendors for other tools. So it's really a mixed bag, and we just looked at, in the end, with the same mindset, what is the best tool out there? We had specifically identified the criteria and what we were looking for and said, this is who we want. We talked about organization, our new global R2R organization. So we have what we call a 3-tier organization. We outsource consistently, as I mentioned, everything that's transactional and rule-based, and we do that by process. So when I talked about the one global process, there are actually 68 sub-processes. capitalizing fixed assets, generating depreciation. So we have 68 sub-processes. We identified those that will be consistently outsourced across the globe for all 190 countries. We then said we're going to take any remaining country activities that aren't going to third parties and move them into operating centers, and we have 5 or less across the globe in some strategic locations. And then basically what we said, all we're going to do is leave in the country anything that's fiscal or statutory related, or very judgmental, booking environmental provisions, booking restructuring provisions, right, where it might be more business driven. So really limited. So we basically had a huge shift of staffing out of the countries into the operating centers to drive the scale that we're talking about. So where are we on this journey? Just to summarize, there's multi-colors here. The different colors mean the different phases in which we've implemented. So I mentioned 2012 was a period of building capability, not only process and tools, but also organization and governance model, which we glossed over quickly. We began deploying on January 1 of this year, so 2013 and 14 are our years of deployment. Through this point in time, everything that's colored, red or purple or blue, anything that's not green, light green I should say, our deployment has been completed. So we've actually deployed our new model. Roughly 60% of Unilever's turnover is now operating in the new ways of working and in a new model. And we have roughly 2,500 new users that we've set up on that journey, both third-party operating center and also country. So we're well down the pike, but as Ken mentions, it's a journey. And we'll be well into, I'm sure, 2014 and maybe a little bit beyond. We've gotten all the big countries on board and operating. We're now dealing with the smaller countries, particularly in Latin America and in Asia. So I just got the 10-minute signal. So here are the couple of key takeaways. So that's all I had. I mean, I could talk for hours, obviously, and where we've been, but just to give you a flavor for our story. But here are what I see as the key takeaways from what I've shown. So first, the transformation really needs to be an integral part. So you can't just say, you can, but it's more difficult. You want the transformation to be part of the overall business strategy. And that really really helps things to a very large degree. Having said that, even though you get that free pass and it's part of the strategy and people are willing to give you funding, you have to justify that funding in a business case. So you really need to be sharp with your cost benefit. I mean, I know it's a motherhood statement, but in the end, nobody's going to give you free money, even if you're viewed to be part of the strategy. So, we really spent a lot of time developing the strategy part of the overall business and clearly articulating both the cost and the benefits and making sure we could sell in that business case. Otherwise, you get no money, even if you're viewed to be part of the strategy. One thing that we glossed over too is while we've been making this transformation, nobody said, Mike or anybody else, you don't have to close the books or report results. So we had to drive this large-scale change agenda while still delivering business as usual. So we still needed to close the books every month. We still needed to report monthly and quarterly and also externally. So it's really a tremendous challenge. I mean, effectively what we did is we changed everything other than the SAP system. So it's really, I made it look neat and clean, but it was a real challenge. And last but not least, and I think this is probably the most obvious thing, driving global scale by centralizing systems and processes, doing things one way is, and I know it's a real difficult thing, not a difficult concept, but really difficult to operate. But once again, it helped with that clean sheet of paper, right? We started, and in the end, we had to move forward in a different way. And obviously, it's a day-to-day battle, but in the end, we needed that mindset change, and that's a key part of how we move forward. So that's all I had. Obviously, Ken and I had indicated that we'll be around afterwards. I think we have another 5 minutes, I guess, Ken, right?
Yeah,
sure. Yep.
I think. Who's ever holding the sign? We have 5 minutes.
Good.
Okay.
Yep.
So we can just kind of click off. I just clicked it off. We had a couple of other summary things. So again, in looking at R2R transform, shorten your cycles, reduce your costs, get this controlled agility. Very key, I think, in Mike's story for Unilever as well. Again, there's a significant opportunity for cost savings here that will help you justify any project or sub-project that you might be doing in your journey. I had to get to my last quote, which is to improve. To improve is to change. To be perfect is to change often. And I think that really relates, again, more to this as a journey. And that also, and Hackett will talk about this too, that I started out the presentation with peer group versus top performers. That's not static. You can be top performer this year and back into the peer group next year. You gotta constantly look and change and reinvent. So encourage you guys to think about R2R as an area that I think is ripe for change. I think can bring a lot of benefit to your organization. And there's a number of different strategies by which you, in places by where you can start in that journey. So with that said, I wanted to just give a plug to our partners. It's interesting. One of our customers, Unilever, used a lot of our partners here. Some that aren't here, but they did. You were a Hackett customer as well, and some of these others. So in any event, we work with a lot of the other consultancies in this area as well. And now we got it down to 2 minutes for questions. So I would just want to open it up before we kind of end for the day. And again, as Mike said, we'll be around as you guys do have breaks and have time. If you have any questions, you can grab one of our cards. They're in the back. You can contact us after the sessions here today, or I'm more than happy to meet with you at the Trintech booth that's on the floor in the break area.
Okay, so I think Tom has a question. Yep.
Yeah, you talked about your white paper that you started with, but I noticed that you're on an SAP platform. Did you have a stable environment in SAP where you're working from, and that gave you the opportunity?
Yeah. We use SAP. We have at the moment 4 platforms. So in different parts of the world, we used to have, I think, 20 or 30 versions of SAP in different ledger environments. But yeah, we do have a stable environment right now. We have 4 different SAP platforms that have been developed legacy within Unilever. I suspect over time we'll get to fewer than more. But yeah, I mean, that's the only thing that didn't change. It created a little bit of adaptability.
Baseline to allow you to make this.
Yeah, so we just this was not an SAP harmonization. So we had 4 versions. A lot of us said, well, gee, why don't we just get to 1? But in the end, there wasn't a lot of, there was a big investment and not a lot of gains. So we said, we're going to work with 4 versions of SAP. And when I say versions, it's just slight variations. But yeah, we said that's a given. This is not an SAP implementation project. We had plenty of those in Unilever over the years. So we said that's a given, and what we're trying to do is build on that. So all these systems, some interface directly, but they're all built on that as a given. Yep. Yeah.
In the slide where you summarized your tools and you have the different categories, I noticed you had 3 areas where there was workflow.
Yep.
Was there means of integrating all that, or an overarching workflow with the other support managers?
Well, I support different processes. So for the journal entry, it works across our organization, so initiating and approving journals. Account reconciliation, same thing, right? So initiating, reviewing, and approving. And then the other workflow really, so the reason why we needed different workflows is anything that wasn't journal entry or account rec needed to support other R2R processes where we were just exchanging information, like fixed asset disposals. So we were leaning towards having one, but just found that we needed one generic one, that it was just to pass information across in a global organization. Yeah. Yep.
I'm curious when you mentioned GL's reporting system and just boiling right down to the preparation of financial statements, 10Qs, 10Ks,
Yep.
Whether you interface with, a vendor, to get into the SEC, what really is the tool to put together the financial statements, and especially footnotes and the edit checks that are present in that tool to mitigate the risk?
Yeah. So what I described is not the back end of the process, which is we prepare financials and report. Right. So we've not tackled that area from a systems perspective. What I was describing is how do we get to the global consolidation? So we have 190 units, countries across the globe. So it's the legal entity consolidation. So it's the feed from local ledgers up through the global organization and then putting that in a position. And they've actually reduced cycle time too, but we've not tackled what system, do we have the best system on the back end in terms, because once again, we're a European-based company, so there's different reporting. We don't do 10Qs. We file under IFRS.
They follow the HMRC.
The U.S. portion, file.
They're all legal entity owned by our foreign operations.
They don't have a 10K or 10Q requirement.
Yeah, so we follow the IFRS and EU requirements, although we do have such significant presence in the U.S. that there's some side filings, but not 10Q. Exactly.
Yeah, there's some debt stuff that they have to file with the SEC, but it's not their standard financials.
See, it's interesting. I know, we're referring to the back end, but that seems to be the conundrum for everyone, where when you work right down to it, preparation of the financial statements, and you had mentioned before the use of Excel, Outlook, Word, right, the desktop version, what do you do? And it seems that the largest companies even still struggle. The use of Excel spreadsheets, combining Excel spreadsheets with Word to get a template and then to get to the SEC, and when you use like a Donnelly or something like that to interface with the SEC, it's still problematic because you're always going to have inconsistencies and a very high level of risk because it's just bits and pieces that you're putting together.
Right. Now with Unilever, we haven't conquered that with them yet. In fact, it's kind of on their. They started on the back end going forward to that point. And again, their big red button would release to the HMRC as opposed to releasing to the SEC. But it's still a regulated environment, so they're going to do. I do believe they do it.
Concept is the same.
Concept is the same.
Yeah.
Right.
Timing,
Yeah.
The regulators.
Yeah. So here's what I would say on that. We have challenged our process there because we used to have a 10-day process in that back end before we go to the markets. It's now 5. And we haven't implemented any new tools. So there's still an opportunity, but the question then becomes how can you squeeze more out of that 5 days, right? Because remember what I said about Alcoa.
Right.
From the day they closed the ledgers in their factories at the lowest level in their organization, in 5 days, they're telling the financial markets how they did.
And I think you also have to look at, is that an integrated process? Is that, if I look at this as more holistically, and if I pick up 3 days on my Rex, I get that extra 3 days down. It's the downhill, right?
So it makes all sense.
You got to look at it holistically. But yes, it's still, and in fact, for people that are now getting to R2R, a lot of the impetus is the pressure on disclosure management because of XBRL, because of changes in regulations, because of a whole slew of reasons, and also another area that is absolutely ripe for change when you're using personal productivity tools to do a very critical institutionalized process. And I'm out of time.
Good, thank you.
Thanks everyone.
Thanks very much.